Do you know why the big banks and market makers always seem to come out on top while most every other trader loses their account over and over again? It's because of one simple difference in how professional traders analyze and approach the market. And in the next 18 minutes, you're going to know exactly what that difference is and how to do it yourself. Let's begin. So, why is understanding fair market value so important? Well, if you can define market value accurately, you can have the opportunity to be early to new trends as they start. This is very important. You can trade completely contrarian to the masses who lose money. Think about it. If 95% of traders lose money, don't you want to know how they're losing so you could do the opposite? Well, understanding true market value will help you to do that. You can maximize gains and minimize risks much better. You can build a solid technical market structure you can use to formulate very creative trading ideas from. And you can trade more effectively in every type of market, including cryptocurrencies. So as a quick refresher, before I show you how to actually draw these value points out on your own charts, I briefly want to go through each one of these aspects and show you how to really use this to make you trade better in all these areas. So let's quickly talk about what the actual definition of fair market value is. Fair market value is defined as a price or a price range that both buyers and sellers have agreed upon in even proportion to one another for a prolonged period of time. This is also defined as a temporary balance in supply and demand, which is the main driver of actual price. Now, when supply and demand become evenly matched, it creates an equilibrium price zone. That is what we are trying to find. When we draw our boxes, when we map out these zones, we want to find that equilibrium price zone. Now, the longer time the equilibrium zone is held, the stronger that value becomes. Keep that in mind. So one of the most important skills you could learn as a trader is how to be early to new trends as they emerge. So how can we use value points to help you do that? Well, again, value defines the tipping point of increased buying and selling pressure in the market. This is literally the tipping point between supply and demand. And we know that because supply and demand is what define this point in the first place. So we can use this to project forward where supply is going to enter the market and where demand is going to enter the market. That way you know which side to be on. When you've defined market value, you know where the new trend will originate from. If we have the value point set at one price point, we know eventually price is going to trend away from that point. So we know where it's going to originate from. Now, when price presents the settling pattern, that's your clue to take action. And you want to let this pattern come to you. So right here, we could see price settles under value. You can see that it's starting to hold under that value line. Now, that provides you with a possible risk-controlled entry if you want to take it. And then you get predictable trending movement that follows. Now, it doesn't always happen this straightforward, but this is a key thing for you to recognize when it does present itself this way. This is a great opportunity. The fact is, if you want to make consistent money as a trader, you're going to have to learn to become a contrarian to the masses. Why is this? Well, 95% of all traders lose money consistently. And if you want to be in the top 5% of those traders, you're going to have to look at things differently than the other 95% because trading is nothing but transferring of money. Think about all the losses that most traders are racking up over time. Those are all funneling to the top 5%. So the top 5% have to be doing something opposite in one way, shape, or form. Defining value shows you where the market will be flooded with buying and selling liquidity. Because we've defined that neutral zone according to the supply and demand balancing point, that equilibrium, we know when it falls out of equilibrium, it's going to start attracting in smart money players and dumb money players, and that's where the good trades are going to happen. So green dots represent dumb money buying. As you can see, as price spikes above value, you're going to get dumb money rushing in out of FOMO. They want to get in. But the problem is that they're buying something that is overvalued. We'd much rather buy something that's undervalued. Wouldn't you agree? Now the red dots, same thing. As price goes down below value, you're going to get people either panic selling or jumping in, FOMOing, shorting the market as well. So again, we'd rather be positioned against them. Defining value shows us the tipping point of who's likely doing what and when. So value acts as the true center of gravity in the market. Dumb money always chases the market. Understanding where dumb money is trading according to value allows you to do the opposite and possibly get amazing trade placement. We want to maximize gains and minimize losses. Since value framework helps us understand where the losing traders are likely positioned, this gives us the best plan for trade entry, risk management, and profit management. And in one simple graphic, I'm going to show you how to use this information to buy the market like a boss. Let's start by mapping out true market value. As we see prices selling off below value, this is going to trigger late sellers to chase the market down when it breaks the previous low. It's a classic retest breakout pattern to the downside. Now, this is going to either cause new short selling or it's going to cause liquidation of old buying positions. Either way, there's going to be selling volume coming into the market, but the problem is that all this selling is happening when the market's already undervalued, showing that they're doing the wrong thing at the wrong time. Naturally, price reverses up through that same level. This provides you the opportunity to trade opposite of that bad position and then monitor your risk right under that price level in expectation that price is going to return to true market value. Now, the main benefit to this entry technique is to first and foremost put you into a really strong risk-controlled position. So even though you're in a really strong position that did in fact put you into the money, you'll notice that price is not really getting up back through value. So it's not really giving you the opportunity to see a really big profit as of yet. So what happens possibly in this circumstance? Well, you know what? In this case, price ended up pulling back further. That's okay. Since you were in a strong position, we'll call this one a break even, maybe a small loss, maybe even a small win, depending on where you got out. But the point is price is pulling back, and we know that because it didn't get through value. In this case, you get the same type of opportunity again at a better price. So you're going to buy, you're going to match that same bad trade from those sellers coming into the market. Price again returns to the center of gravity, which is that predefined value. But in this case, it starts to settle above value. This is the profit zone. This is where you want to maximize profits when price returns above value. Once you're here, you're free and clear. You want to put a stop loss below value and then let your profits run. As price starts to take off, again, this is the tipping point between buying and selling demand. The buying demand starts rushing into the market. Those dumb money buyers come in, and then you, now being the smart money trader you are, start selling your inventory to them for a very repeatable profit-taking process. Mapping out true market value is going to help you build a strong technical structure to work from. Predominant value points make up the backbone of market structure. Mapping multiple value points starts to reveal a grid-like structure that can be used for trade idea formation and management. And why is this? It's because you know where value is in the moment and you know where it's heading to because you can start to see these values stacking in one direction or the other. So that shows you where the smart money is actually driving price. Once you learn how to really identify true market value, you're going to see just how important this information is for gaining an edge pretty much in every single heavily traded high volume market. Look at Bitcoin. On the weekly chart, we had a value structure hold, and that was the beginning, that settling point. That was the beginning of the last major market move. Do you trade Dow Jones? Notice on this one how all the major framework value boxes continue to stack up to the long side, showing that true market value was increasing. If you were trading based on this framework, then the last two major downswings in the Dow Jones would have become massive opportunities for you to accumulate buy positions. And then as price worked back up through those major value points, you would have saw the greed come in and been able to liquidate those positions for a repeatable profit. At this moment, we're facing uncertain times, and during times of uncertainty, the price of gold typically goes up on a fundamental level. However, if you look at where true market value has been established by price, look at every time there was what seemed to be a breakout to the short side. Price just naturally comes right back up to those value points and usually through them. So you can see how powerful this is even on something that's moving in a fundamental direction for obvious reasons. What about stocks like Meta platforms? Well, we can clearly see that the predominant market value structure is still moving up. That means the intrinsic value of Meta platforms is still increasing. Unless we establish value at a lower level now, the current price is highly likely to come right back to the current value point at least. Now that you know just how important mapping out these value lines on your charts are, I'm going to give you the exact formula to draw them yourself. So the first thing you want to start with is a clear trending move. You want to look for a clear trending move that's already recently happened. A new value zone will occur when the market returns to equilibrium after a trending move. This is the point you should start watching the market to show you where the new value zone should be drawn. look for the market to start showing clues of equalizing. You'll see it start to kind of flatten out, kind of not really go anywhere. Confirmed value is defined through a specific type of price action. This formula is actually quite simple. The first thing you want to look for is a confirmed trend high and low point. So this will be a high and a low point within the last trending move. Next, you want to look for price action that does not exceed the last confirmed trend high, and then right after does not exceed the last confirmed trend low. In between these 2 points, you'll find your value point. And this would be the exact opposite if it was after a prior uptrending move. There's also one more thing you could look for when it comes to confirming a value point. The following expansion phase, which is simply defined as leaving value, also plays a major role in confirming this point. The first 2 expansion legs will reconfirm the cycle origination point by returning value or pointing back to it. If you look at turn 1 and turn 2, these both come back to that value origination point that you had already predefined. So this basically acts as a reconfirmation that you defined the right point in the first place. Let's look at one more example just to solidify that you know how to do this. So right here we can see that we had a previous uptrending move and now price is starting to settle. Where is it settling? Well, it's settling in between the confirmed trend low and the trend high, and that is defining our value point. After that, we come into the expansion phase. You can see our first and second leg come back up through that value point, and that points back to that origination point as being completely valid. So now you know all the specifics about how to define true market value. But just to really hit it home, I'm going to go through some live charts and plot some lines so you could watch me do it in real time. So starting with this 30-minute Euro USD chart, what do I need to do to start defining value on this specific chart? Well, since I want to build a little bit of a grid-like structure so I can see the history of where value's been, I want to go a little bit back. Not too far back, but just a little bit. I'm going to start right here. I can see that we had an uptrending move right here. You can see that we had a confirmed low on this candle and a confirmed high, and that was a clear trending move. What I see right here is that price then settled between that high and that low, showing that price was kind of locked into that range. So I'm going to go off of right there as a value point. I'm going to get a line, I'm going to go over here, and I'm going to draw it right in the center of that down and that up candle right there. Perfect. And then I'm going to run that as far forward as it makes sense. I can see that this has already happened in the past, so I'm not going to go too far forward, and I'm going to lock the line in right there. Okay, next thing I'm going to do is I'm going to look for another clear trending move. I can see right here that the market dropped down pretty aggressively. We have a high right here. We have a low at the very bottom, and then you can see the price clearly settled in between. So I'm going to go in the middle of this down, this up candle got real tight. I'm going to go right about here, and I'm going to lock that in. And I'm going to push that forward to about right here. And you can always drag these forward more if you want. It's up to you, whatever feels right. So now we have that move locked in. Okay, now we're going to go find another one. We can see we had another clear trending move right here. Price went up. Right here we had a confirmed low and a confirmed high, and you can see how price became trapped in between those levels. So right here in between those candles, I'm going to take my line and I'm going to stick it right there. And I'm going to draw this one forward, and you can see how reactive that level was after the fact, because that's a true value point right there. We had a reaction here and a reaction there. So you can get even more detailed if you want to. If you want more framework to work with, we had another move from that level down right here. You have a confirmed high, a confirmed low point, and then price continued to be trapped in there. So I'm going to go off of this point right here. I'm going to drag that forward, lock that in. You can see even that was reactive right there on these candles. You can see how helpful that would have been if you were trading this move, not only to get an entry off of here, but also to confirm that you were doing the right thing from right here. This is a pattern that we call walking down the ladder. We teach this all the time in our live webinars. So if you want to, you can even go to real time right now. You have a trending move from this high to this low. We had a confirmed high, confirmed low. It's locked in between those previous high and low points. You can even take another line, stick it right here in the middle of those, and this would also be a relevant value point that you can work with as well. Now let's look at Bitcoin. I'm not going to go too far back, but again, we got a 30-minute chart here. So let's start with right about here. I could see that we had an uptrending move right here, but what I want to look for is at the top of that move, where did price consolidate? Where did it get trapped? That's going to be a good value point to work from. So I could see right here that the market moved up. We had a confirmed high. We had a confirmed low, and then price settled in between those. So I'm going to go off of right here. I'm going to draw that line forward. I'm just going to kind of just put it out here right about there. Good enough. Okay, let's get another line ready. Okay, where else has price trended? Well, I can see from there, it obviously trended down, right? So we have a confirmed high, confirmed low in that trend, and then we get trapped in between those 2 points. So I'm going to go right off the center, basically right in here. I'm going to go right in there where it's tight. And I'm going to lock in my line right about there. So we can see that if you looked at that move and you mapped out that spot, you can see how reactive that became because price did not want to get through that value line. So if you were trading this market short, that would have given you some major clues in the moment. So same thing, market comes up, we're getting more real time. I'm not going to mess with anything in here because there are multiple value points that happened in here and our software would recognize those because we get really intricate with the software, but you do not need to be that intricate to make good trading decisions. Sometimes it really helps. But as you can see with this, you're going to get more than enough to make great trading decisions. So as of right here, we have another move up. And then we can see that price then starts to kind of settle in between this low and the high up here. Or I should say in between this low and this high. It starts to kind of wind up right here. So I'm going to grab another line. And I'm going to stick that line right here at that tight spot there. And I'm going to drag that forward more to where the real-time price is because we are getting a little closer there. So we got that one locked in, and now we're getting close to where we're actually more in the moment here. So we can clearly see a trending move. Here it is, moved from the last value line. That's the trend phase. We can see the market was making higher highs. And then it didn't really settle. I would have liked to see some settling up here, but then we had this pullback right here. But that's okay because I'm trying to look for the first point where the market gets trapped and starts contracting to show us that value at the top of this move. So even though it didn't happen exactly like this one or like this one or like this one, we still have a value point to work within here. And it's if you look at this little down move inside the top of this trend, you can see that price went up, went down, and didn't break the low or the high of those previous this previous down move. So I'm going to go ahead, I'm going to stick a line right in the middle of that, and that's going to be our most relevant value framework to work with right this very moment. And this is probably going to be a very relevant point to trade from over the course of the next day or so, based on this being a 30-minute chart. That's what I got for you today. Hopefully after this lesson, you're going to be an absolute expert at drawing true market value lines. Hey, if you like this kind of content and you want to learn all these types of smart money trading concepts, please be sure to like and subscribe to our channel, and we'll see you on the next video.